Let's talk about why we believe the Bank of England started on a micro policy or micro plan to return back to quantitative easing when they're supposed to be doing quantitative tightening. And the reason why we're going to talk about this is because this can lead to implications across the Atlantic in the United States, because many people are trying to front run the idea that the Federal Reserve is going to pivot out of their policy and start doing quantitative easing, as opposed to quantitative tightening, which is the monetary policy that they need to be successful in the markets. Let's get into this article real quick from the New York Times. So plans by the new Prime Minister Liz Truss to cut taxes, freeze energy bills, impacted the financial market, impacted the pension market, and hit government bond prices so hard that the Bank of England was compelled to intervene. And it gives people an understanding of how some of these obscure derivatives that are on the private market can still shake up the global financial system. So on Wednesday of last week, 30-year British government bonds swung more in a day than they had done in a full year for the past 5 years, the biggest one-year move on record, or the one-day move on record, So Kwasi Kwarteng, the Chancellor of Exchequer, announced Britain's biggest tax cut since the 70s, predominantly for high-income earners, and then also put a cap on energy prices for households that's going to be facing that fuel crisis that's going into the winter. And one of the reasons why this was negative is that investors felt like the government's going to have to increase its borrowing, which means they may be less likely to pay their debt in the future. So then that pushed down the price on existing debt and then it sank the value of the pound. And a lot of people that are really savvy to the FX markets or they understand currency exchange, normally the British pound is way stronger than the US dollar. And so as they started to get kind of close to a parity standpoint, people started to kind of look at the situation a little bit different because that's not normal. So prices move inversely to bond yields within 30 minutes of the British government's announcement. The yield on the 30-year government bond, also known as gilts, soared, moving more than it typically does in a full day. And then that created an impact across the whole world, most importantly on the US market. Let's get a little bit farther. So we're going to repeat that the UK government announced its plan to cut taxes. Yields on gilts shot up as prices fell. The asset managers who oversee the holdings of pension funds began asking the pension funds for more cash to cover the change in the value. So by the end of Monday, the yield on 30-year gilts had risen another 0.5 percentage points, a huge move for an asset that normally moves in the low hundreds of a percentage point. Asset managers begin to press pension funds to post collateral so that they could cover the losses on those derivative contracts. Pension funds, especially the smaller ones, don't have the ability to move quickly. It can take them a couple of weeks to sell assets, including stocks, corporate and government bonds, to raise the money for collateral. So they have people asking them for liquidity, but they don't have the ability to create liquidity in a short amount of time, which created the crisis. So managers were asking for more collateral, but they couldn't wait 2 weeks. They wanted it in 2 days or even sooner. Then that puts a lot of strain on the system. Then on Tuesday, asset managers were still waiting for collateral and running out of time began to close out their trades where they're closing out those derivative positions, putting further pressure on the market because exiting such trades replicates the effect of selling more gilts, amplifying the sell-off. And to me, in my opinion, what really caused this problem is you had too many sellers and not enough buyers. We were not able to find people that wanted to buy these bonds at newer prices based on the macroeconomic situation changed. So then what happened? The Bank of England had to come in and be the buyer of last resort. And what we've seen over the past few years now is that these central banks are having to come into financial markets and essentially create the price floor and support these financial markets with buying because people outside of these particular central banks don't like the current financial situation, and they're not willing to buy at those prices. So they could be demanding a much higher yield to now attract buyers. And to keep people from having to offer that, the central banks will come in and say, okay, we'll just create some type of buying. We'll create demand on this at the current yields. So Columbia Threadneedle said it had to unwind a small amount of trades when the clients were able to come up with the cash needed to cover losses. BlackRock sent a memo to its clients on Wednesday morning saying that for funds close to seeing their assets exhausted, they will close out the trades. Okay, so what we're having is that these money managers are telling the pension funds, we're going to close you out of these positions if you can't create collateral, because what we want is we believe the position now is too risky and we want to close it out. So asset managers pleaded with the Bank of England to intervene, and then by 11 a.m. on Wednesday, they got their wish. So the central bank pledged to buy government bonds at a rate of up to $5 billion a day for the next 13 weekdays in an attempt to restore proper market functioning. So this decision changed plans to sell bonds that the bank had previously purchased as part of a pandemic era support for financial markets. So we talked about before, we're supposed to be going into a quantitative tightening where we're selling assets, getting assets off the books. What's happening is now the Bank of England is saying, well, we're going to buy assets, and they're going to do it supposedly over the next 13 days. However, we want to continue to observe if they extend that and at what amount do they buy. So they're going to post a buy up to a certain amount. Do they exceed that? Is it lower than what they thought they were going to have to buy? And do they also they buy exceeding over the next 13 work days? So them announcing that returned the markets back to normal, took the anxiety out of the market, and then the yield on the 30-year gilt fell more than a percentage point on Wednesday. And one of the reasons why I do what I do is I want people to really understand how these markets work and how they're constructed, and not understand it, but able to understand it and go in and act on it. And what we've seen is that people panic without a certain monetary policy. And I think that goes over a lot of people's heads because it's not their day-to-day conversation. And we really, and then they ask for somebody else to come in and save them. And they say yes. And so what we understand is that there is not a true supply and demand mechanism. It doesn't exist. And this is why I tell people, don't buy into this free market stuff. It doesn't exist. Because if the free market really existed, what they would do is they would let the British bond yield go up to a number in which it would attract demand. And if that number was 25%, then it's 25%. But what it also would do is that it would destroy the British pension fund market. So then now all of these British subjects or British citizens, I don't know if that's the proper word, that are depending on pension funds to live off of, that could be negatively impacted. It also would impact people wanting to put more money into the fund. And this is what I want people to understand. There is no free market. These markets are controlled, and the central bank's job is to do what they think is in the best situation for the economy that they're supposed to be managing. Because if we really were operating on a free market, we would let the bond yield continue to go up till it will attract demand. We wouldn't tell the Central Bank of England to come in and support the market with liquidity. And that's what I want people to understand. So if you're operating in this market believing that, or, I just believe in a free market, no, you don't. Because a free market involves markets crashing. It involves whole sectors of markets going bankrupt because there's no demand there. So people have to sell their assets at distress because they lose liquidity. It involves whole sectors of the market imploding, and you're dealing with the fallout from that. And what it will do is create a lot of volatility in the market, which hurts people. And that's really what a free market environment, if we just sit back and say, well, nobody's going to help anybody. If you take a position and your position goes against you, you just get blown out of the water. It is what it is. What you would get is massive volatility in the market, which then would hurt other areas of the market because they're linked together. Because we see in this particular example, the pension funds are linked to a derivatives market, which is linked to the large money managers. So they're all connected together through relationships. Therefore, when the pension funds started experiencing a lot of stress, the money managers told them, okay, what we're going to have to do is close out your position, which then now it starts to impact the ability for the pension funds to pay out at the rate in which they were supposed to be paying out, not only now, but most definitely into the future. And then once you can start putting these pieces together based on how this thing is actually constructed, and then you can operate based on how it's constructed and not this ideology that you're being fed by people on the internet who don't trade, you're going to put yourself in a position to be really successful based on my opinion. But I don't operate in the market, think that I'm operating under a free market or I desire for a free market. I don't desire for free anything because there is no such thing as free. These markets are constructed to benefit the people that built the market.
A plummeting pound, soaring costs of long-term borrowing, a material risk to UK financial stability. And today, intervention, a dramatic intervention. The Bank of England announced today it will buy unlimited quantities of government bonds at a, quote, urgent pace. Action carried out on, quote, whatever scale is necessary to ease investor concerns. But this major intervention wasn't designed in haste to just restore markets, but to stop mass insolvencies that could have begun today.
Pension funds have invested heavily in these particular types of government bonds because they're usually seen as a safe investment. And to buy them, pension funds have often borrowed money from big banks. But as of last Friday, the markets seem to have lost their faith in these safe investments and the value of them has plummeted. So the banks have turned around to the pension funds and said, in these uncertain times, we're going to need you to give us some cash, some collateral. And this is often called a margin call. But to raise that cash, pension funds have ended up selling yet more of these bonds, causing the value of them to spiral even further downwards. The movement in the market has been so significant over the last couple of days that the market has effectively stopped working. So much so that, as of this morning, there were fears, we understand, that large UK financial institutions would go insolvent, effectively go bust.
What this is about making sure that the United Kingdom is a successful economy.
That was the Prime Minister on Friday, backing the tax cuts her Chancellor had just announced, which prompted fear in the markets. Today, from the Prime Minister and her Chancellor, silence. From the Business Secretary,
why has the Bank of England been forced to intervene, Mr Rees-Mogg?
Silence. Silence from the Levelling Up Secretary and silence from the Chief Secretary to the Treasury.
Do you think that the Chancellor is fit to continue the role?
But we did get this defence from the Financial Secretary to the Treasury, Andrew Griffith.
For a lot of people, they're looking at what's happening in financial markets and they see a storm, that started with that fiscal statement last Friday. Do you not take responsibility for that?
No, we both know that we're seeing the same impacts of Putin's war in Ukraine cascading through things like the cost of energy, some of the supply side implications of that, and that's impacting every major economy. And just the same, every major economy, you're seeing interest rates going up as well. So as we go...
Not to the same degree as in the UK.
Every major economy is dealing with exactly these same issues.
That's an argument that doesn't stack up, says the Labour leader.
This is self-inflicted. This was made in Downing Street last Friday. And for what? For uncosted tax breaks for those earning hundreds of thousands of pounds. And so what the government needs to do now is recall Parliament and abandon this budget before any more damage is done.
We don't know what the market's going to do. That's what we're saying, basically, on that.
Uneasy investors had been demanding huge interest rates in order to lend to the government through bonds, which sparked fears of major interest rate rises for us all. At this mortgage broker in Cambridgeshire, they're hoping action by the Bank of England today might ease that pressure.
Ultimately, if that reduces some of the volatility that we see in the markets and hopefully this talk of interest rate rises, however much we can negate that and try and bring the rate rises down as much as we can, they're going to go up, there's no doubt about it. Any stability that can bring to reduce or delay those rate rises can only have a positive effect.
Do you think today's action is enough to get us out of the woods long term?
It is unlikely to be sufficient. The Bank of England managed to buy some time for the Treasury. Ultimately, we would need more clarification from the Treasury in order to calm the market. The Bank of England can assist to some degree, but it's not actually going to be able to resolve this.
The Bank of England's intervention today came after stinging criticism for the government by the International Monetary Fund for their economic plans. As billions are spent to ease markets, the government say they have a plan and are sticking with it.
Where we expected the Bank of England to step up on rate hikes, they're buying bonds. Guy, make sense of it all for us.
I'm struggling to see what this has fixed, John. Other than sourcing out the pension funds, this is a real struggle to see what has actually been achieved here. So as you've been pointing out, Lisa's been pointing out, the pound is down. We're now trading on the cable rate at 105.91. If you take a look at 2, 3, 5-year swaps, which is what mortgages are priced off, they've barely budged. So the impact into the mortgage market is not changing here. So the pension funds, which carry long duration debt, are the ones that are going to benefit from this. But even there, we're only back to where we were at the beginning of yesterday, John. So yes, we are getting a monster move, but it comes on the other side of a symmetrical move that we've seen. So that chart says it all. Look at what is happening here. Actually, that's just the 2-year. But what we're seeing here is basically just a reversal from yesterday's position, and it's incredible to watch. The currency is down, John. So let's just run through the mechanics of this briefly, if we can.
Wow.
This is an FPC decision, not an MPC decision. Effectively, it's a recommendation. So this is stability, financial stability that they're doing. That they're effectively trying to deal with here. So it's not a monetary decision which comes later. That's what we need to talk about in terms of the rate hikes.